In the run-up to the end of last year, we felt that equity markets were quite expensive. And we had been selling some of our high-profile technology shares, what people call the FANGs. So even earlier than that, at the end of 2017, we were selling our holding in Facebook and our holding in Amazon. Then we sold our holding in Tencent, big Chinese internet company. All very good companies, but well above the valuation levels that we feel comfortable holding shares. And it's a good thing that we did sell those shares, because all of them got caught up in the turbulence in the last quarter. Towards the end of the year, though, a number of tech companies became very heavily sold off, particularly companies which are involved in world trade, because people were worried about the trade dispute between America and China getting worse, and perhaps Donald Trump behaving erratically. So right at the end of the year, some of our automation stocks became very inexpensive. We managed to pick them up. We thought that there were real bargains there, and that's proved very successful over the first couple of months of this year. Right at the end of last year, there was really quite a vicious sell-off in December, and we thought that threw out some real bargains. We topped up some of our automation stocks because they had actually traded quite badly during the sell-off in the last quarter, and also because people were worried about whether the trade war between America and China was going to get worse. People didn't trust Donald Trump to behave sensibly. I can understand why. So some of these stocks, particularly the Japanese stocks, were really on their backs. And we topped these stocks up around the end of last year, and they've all bounced enormously vigorously. So the amount of money we added right at the bottom of the market, we've now taken profits in that. It still means that we have a good exposure to that part of the market. But the bounce back in the market has been so vigorous, we think this is another good opportunity just to settle the portfolio down, not to hope for too much. The economic growth figures out, despite this market bounce, have not been encouraging. The world is slowing, particularly the European economies. The American economy seems okay. And so what we've done is we've moved a little bit of money back to America, but we've also bought some more defensive stocks. One of our largest purchases recently has actually been a UK stock. The UK's obviously been under shadow because of the Brexit negotiations, and that's thrown up an opportunity for us to buy what we regard as one of the best quality companies in the UK, which is Segro, the company that operates the industrial estate around Slough. It used to be called Slough Estates. So that's automated industrial warehouses. Again, automation creeps in as a theme. And because they've computerized and robotized these warehouses, they're in very, very high demand. They're all around Heathrow Airport. So as long as the British economy doesn't crater, those warehouses will be full, and they'll be taking very good rents out of them. And UK interest rates are still very, very low. So, when you're investing in a property company, you get the rent and then you pay out the interest, and the difference is your rent as a shareholder, and that's very, very healthy for this company. It has been for a number of years, but the buying opportunity is thrown up by the uncertainty of Brexit, perhaps. We have a collection of holdings which we call healthcare, but and this is one of the biggest exposures in the portfolio. It's probably the biggest exposure if you add it all up. It's over 20% of the fund. Our focus here is on companies which are able to produce world-class healthcare cheaply. So we own no drugs companies at all. Drugs companies rely on coming up with brilliant inventions, but then they have to charge a very large amount for the drugs. Otherwise, they don't get a profit after the enormous cost of research and development. So our companies are companies that deliver healthcare cheaply. Some of the largest are the American health insurance companies. Now, of course, these were in the shadow when President Obama tried to introduce Obamacare for all, healthcare for all. Since the Trump administration has come in, that's been on the back foot, but we expect it to return as a policy now that we're into the election cycle in America. So some of these shares have come down. But the truth of the matter is companies like United Healthcare and Anthem, both of which are very large holdings in our portfolio and very successful holdings in our portfolio, they have to persuade big companies to sign up for their health plans for the employees. So they have to show that they produce good value for money, good healthcare for affordable premiums paid for by these companies. So the reason healthcare in America is very expensive in terms of the premiums is because the healthcare is very high quality. But those premiums are mainly paid for, if you work for a big company, by the company themselves. You then pay a copay if you get ill. Of course, that doesn't help the people who are uninsured and the people who don't work for big companies, which is the Democrats' point, and they're quite right about that. But the bulk of American healthcare is managed by these companies, which, if you like, are the American equivalent of Bupa. And they have massive buying power, and they're very efficient at delivering healthcare effectively to that very wealthy population. We think that they're going to carry on making very good returns for us for a number of years to come. We spend a lot of time looking at technology companies, particularly because they're new business models, so they will challenge old business models. They'll challenge the business models of companies that otherwise one might think are a reliable blue chip and no longer are. I think the example of Netflix is the best one here. Netflix has produced a fantastic program suite for people at a very affordable price. In fact, at a price which doesn't really leave the company making particularly good profits. So it's damaged the business model of old reliable businesses such as Disney that we used to own. So by studying Netflix, we decided to sell Disney, and that saved us a lot of money because Disney's had a lot of problems and has lost a lot of subscribers recently. It doesn't mean to say that we decide to buy Netflix. The calculation you have to do to make that decision involves a lot of assumptions. How many customers will they have in the long run, and how much will those customers be prepared to be charged worldwide? And both of those numbers are slightly finger in the air decisions. And we don't need to make vague decisions like that. There are plenty of good, solid growth companies with reliable profitability that we can invest in without having to go that far out in terms of forecasting. It's rather the same in terms of Tesla. The Tesla business model involves much more capital investment, and again, to work out when it becomes profitable and how profitable it becomes, you've got to work out how many cars they're going to sell in 5 years' time, how big a margin they're going to make, how much more capital they've got to invest. All of those assumptions are too risky for us, I think. And when we look at the value put on the company today, it's quite clear that other investors are much more enthusiastic, much more confident than we would be about making those sorts of forecasts. Again, we can find plenty of other very good growth situations where we can value the stocks with much more certainty than that. We're having spent a lot more time as global investors keeping an eye on politics, American politics in particular. The Trump White House is certainly more unpredictable than White Houses in the past. But I think it's worth bearing in mind, President Trump loves publicity, the press loves writing articles about him, but the American system does have good checks and balances in it, and some of the more absurd policies he's come up with from an economic point of view have been tempered. Moving on to the Fed is independent. The president is saying he wants to try to bully it and tell them what to do about interest rate policy. We thought that the Fed needed to put up rates last year. They did. We didn't think they needed to put them up this year. They haven't. For us, it all makes perfectly good sense, and I don't think the president, I don't think there's much evidence of interference from the president. The policy is perfectly sensible. America's slowing. There's not much signs of inflation. It's a very healthy economy to invest in at the moment. Where politics worries us rather more is probably in Europe, where clearly we have the threat of a Labour victory in the next election in the UK, and their economic policies are certainly anti-capitalist. We're investors. We will not like those policies. We would regard that as a very negative development if it happened. But secondly, the rise of populist parties in Europe, who again don't have economic policies which add up, is worrying. Some countries in Europe are doing perfectly well, such as Germany. Other countries in Europe have still got very high unemployment 10 years on from the financial crisis, such as Italy. So those tensions are likely to carry on, and they can feed through and affect companies and affect stock markets. So that's one of the reasons why we're slightly more cautious, rather more cautious about the European opportunities than other opportunities around the world. There's not that much growth, and the economic and political problems aren't going to go away anytime soon. We don't actually think that Brexit will be a disaster. We don't have to take a view on it because, as you say, we have a very small allocation to the UK. It's 6% of our money at the moment. That's actually more than we've had in the UK for the last few years because some opportunities have been thrown up by people worried about Brexit. The difference between one Brexit deal and another Brexit deal, saying that we leave, is the difference between one trade deal and another trade deal. And we haven't got British manufacturing companies in our portfolio. We have big strong international businesses such as Diageo making whiskey or the Prudential operating life assurance companies worldwide, those businesses will not be particularly impacted by one Brexit deal or another. And if there's no deal and we stay in, probably the whole market will go up. Global funds will probably do slightly less well than UK funds in those circumstances. We worry much more about the next election and the gap between the Conservative Party policies and the Labour Party policies under Jeremy Corbyn. Those we think would be really very bad for UK investors.